Thank you for joining us for our COVID-19 update. Today, we are doing a Q&A on the CARES Act and the PPP loan program. Hi, my name is Lee Schwartz. First of all, on behalf of SVA, we hope you're doing well both personally and professionally. If you've been with us for previous webinars, you've heard this spiel before, but please hang with me here for a sec. We've been doing our best to be a resource for the business community, and today's webinar is another way in which we're trying to communicate out the latest and greatest information available. Today's session will cover everything we know at this point in time. Please keep in mind this information is fluid and has been changing quickly. So last Tuesday, we covered SBA's recent guidance regarding potential payback of the PPP loan, and we walked through the loan forgiveness application. If you're looking for more in-depth information on those topics, that webinar is available for viewing if you go to our COVID-19, the COVID-19 page on our website. Today, we're going to start out covering a few changes that have come out since last week, and then we'll dive right into some questions that you all sent in ahead of time. While we're doing that, you can open up the chat function at the bottom of your screen and address your question to all panelists. I'm going to do my best to take some broader questions first, and then we'll work towards some more specific questions that you all may have. Now, if your question doesn't get answered in the next hour, or if you still have questions coming out of this webinar today, and you're an SVA client, reach out to your SVA professional. We want to help. Unless your typical contact is one of our presenters, please don't reach out to them directly. We're trying to make sure that we don't have a bottleneck of questions all directed to just a few people. Now, if you're not an SVA client, your best bet may be to go to your existing CPA. They know you and your business best. But if that doesn't work, and from what I've heard from many of you, it hasn't been working, you can feel free to reach out to me directly. While our clients are obviously taking up a lot of our time right now, we also want to be a resource for any business out there who needs help. Like many of you, SVA is an independent, Wisconsin-based business, and we need to help each other right now. Also, we are recording this webinar today. You will receive an email with a link to a survey, as well as our SVA resource page where the recording will be made available. With all that out of the way, and thanks for bearing with me, our presenters today are Nancy Melberg, Eric Trost, and Dan Glonsky, all principals from SVA. Having said that, I'd like to kick it off to Eric.
Thank you, Lee. Might want to invest in a little tighter internet connection there for the next go around, Lee. You were a little choppy there. All else before has been good, but today's for some reason was choppy. So I'd like to start out today talking with the seminar on the PPP and some latest changes and what we expect for changes to come. So we'll go to our first slide. Thank you. So considering the number of times the guidelines have been changed since the initial rollout of the PPP loan program, okay, and I'll stop there for a second. The guidelines have changed quite often. The loan started with essentially legislation back in March, and there's been about 15 updates from the SBA since then with tweaks to the rules. So can we expect a similar number of changes in the loan forgiveness application process, or would you assume the forms that are currently out will pretty much stand the way they are? So I'm pretty sure we can say that there's going to be a lot more changes to come. The loan forgiveness application was released last week along with some guidance on the said application last week. To date, the SBA has been averaging probably 2 pieces of guidance a week on the application process and information surrounding how to get, what expenses qualify for the loan forgiveness and how to measure them. Friday's guidance with the application release also added some new guidance with respect to, say, the 8-week period and a new alternative 8-week period. There's more questions now than answers yet, and that's what's really prompting, I think, the SBA to continually release this guidance. And so fully expect to get more along the way And not only that, that's just the SBA. There's actually a couple bills in Congress right now pending that do have bipartisan support that I believe are likely to pass in the next couple weeks. In fact, I believe the Senate has a vote this week on one of those bills. And those bills are geared towards moving the PPP, I think, more in the direction it was originally intended, and that is a grant for small businesses to keep payroll going. So the initial legislation seemed to indicate that's what this was going to be, as a grant to small businesses to keep payroll going. Then the SBA kind of vacillated on some of their guidance, maybe tightening restrictions that I don't think was the congressional intent, but it was the SBA's reading. And now I think what's happening is Congress has gotten enough feedback that they are considering expanding some things to make this program even friendlier for small businesses, such as the couple things that are in play right now in legislation are expanding the 8-week period to either 16 weeks or 24 weeks. So that would have the effect of increasing the amount of payroll and other expenses that could be forgiven, and in essence, maybe using up all of the loan in loan forgivable expenses. So I think that would be a shift, certainly towards a business-friendly shift. And there's also a bill looking to drop the 75% rule. That 75% rule is 75% of forgivable expenses must be payroll costs. And that rule right now is in existence, but Congress is looking at getting rid of that rule, meaning that there is no 75% test anymore. So I believe in the next couple of weeks, we're going to have both SBA guidance on how to measure these forgivable expenses and what all counts, and we're going to have some more legislative guidance that will help give a more business-friendly approach to measuring the expenses and getting more of this loan into the forgivable category. With that, I'll move on to next question. And is this you, Nancy, right?
It is. Thank you,
Very good.
Eric. And thank you everyone for joining us for our weekly, what I'm calling our PPP book club. It's nice to see everybody back again. So the first question we have here, and Eric just kind of mentioned this, but I want to clear it up a little bit, is are the capping of the wages at 75% of the loan amount? No. So it's 75% of the forgivable costs. So remember, the loan was a calculation of average monthly payroll times 2.5. But the actual payroll costs are 8 weeks of payroll plus health insurance, benefits, SUDA, retirement plan. So we have some discrepancies there in the amount. So the loan is not always going to be the actual costs that you incurred in those 8 weeks, because obviously we're dealing with different time periods. So the way you're going to calculate that is you're going to take your 8 weeks of covered payroll costs and you're going to divide those by 0.75. That's going to give you the total amount of the loan, which will then give you the 25% allowable for other expenses. So if you had $45,000 in payroll costs in these 8 weeks, you're going to divide that by 0.75. That's going to give you $60,000. So you have $15,000 that you can spend on other costs, rent, mortgage interest, utilities. So that's a great question, and I've seen it a lot. So hopefully that clarifies that. I'm also going to answer question 3 here. Can you explain how the simplified approach to figuring the FTEs and the PTEs, is it weekly, every other week, over the pay period? So what you have to do here is you're going to have to do a calculation. It is per pay period. So if you're a biweekly payer, if you're a weekly payer, you're going to take the total of each pay period of those hours worked. You're going to put it in a spreadsheet. You're going to sum those up, and then you're going to divide it by 40. So you're going to take the average of all those. you're going to divide that by 40. That's going to give you the total number of FTEs. So it really depends on how your payrolls run. If you're a weekly payroll, bi-weekly payroll, but what you want to do is you want to take that and you want to do a calculation in an Excel spreadsheet that calculates those amounts every pay period. Then you're going to take that and you're going to average that over the course of the 8 weeks to get your FTE. The simplified method is going to be something totally different. So what the simplified method does is it takes that average, and anybody who's 40 hours is 1, anybody who's under 40 hours is 0.5. So there is no calculation of average hours divided by 40. It's just if their average is 40, they're 1. If their average is 39, they're 0.5. So I think what I really want to emphasize here is make sure that you're calculating it both ways, because you want to see which way provides you the most benefit. If you were an employer who has a lot of part-time employees, say anybody under 20 hours, then you're going to have a lot of 0.5s. If you have a lot of people that maybe you as an employer consider 37 hours full-time, then you probably want to do the actual calculation and you want to do that average divided by 40, because otherwise you're going to get very different amounts, because people at 37, 36, they're only going to be considered 0.5. So the other thing to remember here is whatever method you choose in the 8 weeks to calculate on, you also have to choose the same method when you're doing the reference period or look back period. So I think in the application, they refer to it as reference period. I tend to refer to it as look back period because it's the period you're comparing the FTEs to. So you cannot use one method to give you a higher number in your 8 weeks and then use a method that gives you a lower number in your look back period. You have to be consistent with these 2 periods. So hopefully that covers that question. So now we're going to move on to the next question. Dan, I'll let you jump in on this one.
Sure. Before we drop on to the next one, I think there was a question there on related to number 2, which regarding the 75%. The follow-up question to that really was if I had an 80%, let's say when I go through my 8-week period, I have 80% of the covered costs. Am I able to take that full 80% of those payroll costs as forgivable?
Absolutely. The 75, so the 25% is the maximum that you can use in the non-payroll costs. So if you have 90% in payroll costs, you only need 10%, but you can still take that extra 25%. So absolutely, 25% is the maximum that you can take in non-payroll costs.
Right, and I would agree. The 75% is kind of a byproduct of when we talk about non-payroll costs. The reality is the non-payroll cost, which is limited to 25%, is really what you should be focusing on. But payroll costs can go above the 75% if that's reality. So question number 4. So the question is, I'm struggling with my piecework and commission on salespeople. When calculating the payroll forgiveness, I have a repair tech and a sales rep that do not log in hours worked. The techs are paid piecework and the sales reps are paid straight commission withdraw. How do I calculate the FTEs, and where do they fit, where do they fit in any other area? Am I maybe missing? I view piecework and commission individuals as salaried individuals. So we don't have an hours analysis determine whether they have a reduction in full-time or part-time equivalent. I would, in my opinion, categorize them as full-time employees. However, I do think you have to look, or I would expect that you look at them from a wage reduction standpoint. And that, for example, if in the first part of the year you paid somebody, $20,000, and then in the next 8 weeks during the forgiveness period, you're paying them $5,000. I think we have a wage reduction, and I think that has to be factored in onto your analysis. But as far as number of employee count, at this point, I don't believe the instructions lend to having to reduce that. I'll leave that open for the other panelists to comment whether they agree or disagree with me on that. But that's how I look at the commissioned and piecework type of people that don't really have hours affiliated with them. I view it more as a reduction of salary or wage based on productivity. So hopefully that answers that question.
Dan, I do agree with you. And, you know, the one thing that I want to point out is that the FTE reduction and the 25% reduction, the way the forgiveness application was written, it was written in such a way that a person couldn't take a hit on both. So in other words, they're trying to reduce the amount of reduction that a person is getting on the application by not reducing them in an FTE status and in a wage reduction status. So I would agree with you, Dan. I think in this situation, if there were any reductions, it would fall under the 25% wage reduction versus the FTE reduction.
Okay, question number 5.
So question number 5 is talking about the application. So it says in step 2A under the alternative wage safe harbor calculation, what is the reference range for determining the average annual salary or hourly wage of February 15th, past 12 months, January 1st? Or then we also say, basic question in 2C, the alternative wage safe harbor, what is the reference rate range for average salary or hourly as of June 30th? Okay, so this is actually where it's going to get a little bit complicated in the application. And the reason for these different time frames is because, again, they're giving you an opportunity to meet a different safe harbor. So when we look at the safe harbor for the wage, we have an annual average. So if you have a salary employee, what you have to do, and again, this is in regard to the 25% wage reduction, is you have to take that salary that has happened in the first quarter and you're going to annualize that salary. When you have that salary annualized, that's going to determine whatever that annual salary is, up to 75% of that you can pay without any reduction. So you can reduce that annual salary as much as 25% without taking a hit. So that's one thing. Then when we're looking at these different periods up above, this actually comes into play in the FTE calculation. So what the calculation is allowing you to do, because remember, in the forgiveness, we have the FTEs in your 8-week covered period. Then we have the FTEs at June 30th. And if there was no safe harbor besides just the June 30th, you would just take that and you would reduce the FTEs from where you were in your look back period to where you were in your 8 weeks. And you would compare that to June 30th. If on June 30th you restored them, you have no reduction. Well, what this calculation is actually doing now, and again, this gets a little bit confusing, but this calculation is giving people a further step that they can do. They can look at FTEs between 215 and 426. That's one calculation. Then you can look at your FTEs on 215 of 2020. That's another calculation. Then you can take, you have to take the greater of those two numbers, and you can compare that number to 630. If your FTEs on 630 is greater than or equal to that number, not the 8-week covered period number, then you've satisfied the safe harbor. So that is the purpose between these two periods. If your FTEs between 215 and 426 is less, then you actually have to do the calculation of comparing the 630 number to the 8 weeks. So again, I know this is very complicated. And I think the good thing about this is if someone is filling out the application and they're just following the application does walk through this. And I know at times people aren't sure why they're putting this number in, or do I really need this number? And I would say yes. Just follow the application exactly the way it's referenced in there. So it does mean that you're going to have to do a lot more calculations on your FTEs, but I think it's going to be very, very beneficial to people to do that, because it could mean that you meet a safe harbor and that you have no reduction versus if you just look at those 2 periods. So remember, when you're doing these calculations, you're either using the simplified method or the actual method, and you have to apply it to all the calculations. I hope that answered that. So I think, Dan, we're going to move on to number 6 for you.
Perfect.
Actually, Nancy, can we break back into number 5 for a minute?
Absolutely.
So what you explained there is going to be very complicated as far as the different safe harbors. And I think we want to make sure people understand the importance of meeting a safe harbor. Meeting a safe harbor means what, Nancy?
It means that you do not have to take a reduction on the loan forgiveness. So let's say that you had a $100,000 loan. Let's say that you've spent $100,000 in payroll. So it's not automatically forgiven at that point because you spent it. Now let's say that your FTEs from your 8-week covered period and your look back period were reduced by 25%. That means what you have to do is you have to take that $100,000 that you spent and you're applying for forgiveness on, and you have to reduce it by $25,000 or 25%. However, if you meet this safe harbor, even though in that first calculation you have a 25% reduction, if you meet a safe harbor, which means another opportunity to meet this. So now let's say on June 30th, you restored your FTEs, even though you didn't have them in the 8 weeks, but you restored them on June 30th, you can ignore that 25% and you do not have to take that reduction in the forgiveness. So it's giving you an opportunity to not have to reduce your forgiveness. Did that clarify it a little bit better, Eric?
Yeah, right. And so really what happened is there was one safe harbor, the June 30th safe harbor, to restore your employees, and you would not have to do any of these forgiveness reduction calculations. These instructions for the form added this second safe harbor that you just explained here. So you have a couple different ways to make the safe harbor, and that's why it's important to do these calculations. Is if you fail one safe harbor, you might make the other safe harbor. And making these safe harbors means that you don't have to do a reduction in your loan forgiveness amount.
Correct. Now, if you look at June 30th and you've restored them all, you don't have to go any further. You're done. So this is just if you see a reduction, then you might want to take the next step. But if at June 30th, you are equal to where you were in your look back period, you're done. There's no reduction.
Nancy, this question though related to the reduction of compensation that's forgivable, right? There's basically 2 reductions that can happen in the forgiveness program. One is it's the full-time equivalent reduction in employee count, which I think is more of a dramatic effect on your application. And then there's the wage reduction, which is, you're paying somebody a lot less in the 8-week period that you paid them prior. And as a result, the amount of forgivable compensation that is in that 8-week period is going to be reduced unless we meet one of these safe harbor, which means bringing people back up to the level that they prior were at.
Right. Yeah. So the 25%. So this question here actually kind of crosses over because these time periods are actually related to the FTEs. But the 25% basically says that you are going to look at the average annual in Q1, and then you're going to compare that to your 8-week. And that's either on an annual salary or on a per hour rate. So again, I'm going to give you an example. Let's say in Q1, you paid somebody an average, and you have to do that calculation of $10 an hour. So if we take 25%, we reduce that. That means we could have lowered their salary up to $7.50 without having to take any reduction. And again, you're going to do it on a salary and an hourly basis. And then only the difference, if you paid them $7 an hour, then that 50 cents differential is what you have to do the calculation on for the forgiveness. And again, this, you know, we've got some Excel spreadsheets that calculate, but again, I think if you follow the application exact, it walks through this. But these actual dates in the first part of the question refer to the FTE calculation.
Yeah, I actually found this section probably the most complicated. They give you the words, they don't really necessarily tell you what they mean. You know, for example, they combine average salary and hourly wage in the same sentence. Well, what am I talking about? But if you walk through the example, there's actually two separate calculations. One if you're looking at hourly employees, and one if you're looking at the average salary. And again, the average salary is an annualized number that then determines your ratio of reduction, which is then applied to that 8-week period. So again, kind of keep walking through the steps within that part of the application. Certainly feel free to bounce some clarification questions off of us. But if you're struggling with this section, we spent a lot of time going back and forth on really what does this mean and how does it get implemented. All right, so we'll move on to question 6. So please explain the alternative payroll covered period. Another good section that might have some clarification in its future, but at this point, our interpretation of the alternative payroll covered period is the ability for a person to pick a different payroll period than starting the date that you received the loan. So to back up a step, the application started with a covered period. The covered period is defined as the date you received the cash from the loan process. And so once that was dispersed to you or made available to you, from that point for the next 8 weeks, that is your covered period by application and statute interpretation. The application then added this alternative payroll covered period, which allows you to pick a possible alternative forward. So where it is it's the first, you're allowed to pick either the covered period, which is the day I got the loan, or the pay period start date of the first payroll after you got the distribution. So for example, if on April 10th, I received a distribution from the bank, and on April 12th, my next payroll cycle starts, then I'm able to move that alternative date to that next payroll period, to include that next payroll period, and count my 8 weeks from that period. So it allows you to potentially advance it if you're starting to bring employees back and so forth. That might be something that you want to consider. The consequence of that is some people pay, let's say I work 2 weeks and then I don't get paid, those 2 weeks I don't get paid for maybe a week or two later. So all of a sudden it keeps pushing out that payroll period to the point where you could go past June 30th. Obviously, we wouldn't expect that they would basically allow you to select an alternative period and then have you lose something on the backside because you didn't pay it in time. So we expect some clarification on that, but we do have the ability to push that out, to the next available pay period or start period that you had the payroll after you receive the distribution. So that's really the alternative. Now that only applies for the payroll costs. If you have rent, utilities, and all those things, those go back to the covered period. So there's no changing of those particular dates.
And I do just want to make a quick comment that this alternative covered period is only allowable for people who have a bi-weekly or weekly payroll. So it's not available to use for semi-monthly or monthly payers. And Dan, can you explain the difference for everyone between pay period and pay date? Because I think this is where a lot of people were getting hung up on the clarification.
Yeah, so the pay date is the date that the obviously the disbursement is made to the employee via check or direct deposit, whereas the pay period is when basically the employee has earned that compensation. So if I had a payroll that went from April 1st to April 14th, my pay period would start. So my 8 weeks starts for the alternative April 14th, because that's when that pay period ended, and that's when the employee incurred, in essence, that compensation. So it's more of like an accrual type of look at the activity, but it moves it from, now they might pay that payroll, they could pay it another, let's say on the 21st of April. And if they pay it on the 21st of April, that's not what we're looking at in this alternative payroll covered period. We're looking at that April 14th date. So that's the distinction between the two. And, if you receive the loan in April, selecting alternative pay period probably gets you before June 30th as well, but it allows you some flexibility of picking up some maybe additional compensation to include.
So I do want to mention, and Dan, you and I talked about this yesterday, that you're going to have to really work this through before you choose it, because there could be a possibility that you could maybe lose a payroll if you choose this, depending on the timing. Because remember, the alternative payroll begins on the first day of your pay period. So if you got a loan on April 1st, your pay period started April 7th, it's 2 weeks. Now we go to April 21st and you don't pay for a week after that. Maybe we're April 28th. So you can only pick one pay period on the back end to include in this. So I think you have to be careful of timing, because it doesn't start on the date the check was cut for the next pay period. It starts on the day the pay period begins. So again, I think there's a planning opportunity for many people here, but just be aware of that.
Yeah, and the reason we say that, to be aware of that, is there's another criteria in this, that the payroll, in order for the payroll cost to be forgiven, it has to be paid and incurred by June 30th. And there's an exception that allows for a payment after June 30th, but it only covers, it has to be paid before the next payroll process. So if you have a 2-week delay, it's potential that you might have 2 payments after June 30th, of which only one of them you'd be able to pick up. Again, we expect some clarification on that. We don't think that that's technically the consequence that you should incur, but we want to make you aware of it. And as you plan and kind of be aware of those changes, but as you pick the alternative payroll covered period, you want to be aware of that. So to add on to the question, so it says if we have, with payroll and rent costs, we are shy of the loan amount, would we just return any unspent proceeds? I mean, you have the ability to hang on to that loan and continue to use it up to, I think it's 2 years at a 1% interest rate. So again, depending upon your financial structure or situation, it might be something that's worth continuing to carry on, but it will have to be repaid at some point in time. So if you want to just get that taken care of, obviously you could return that. The other piece is, we have employees work more hours normal prior to the COVID. We're allowed to give them bonuses from the PPP funds. At this point, there's no indication that we can't increase people's pay and pay bonuses. The caution on this is we have continuously got additional guidance. And the concern is that if you go ahead and pay somebody a bonus that potentially you weren't going to pay, or pay somebody money that you didn't really plan to pay them, but you're just paying it to use up the proceeds, you want to be careful that you don't get held holding that bag, meaning that I paid this employee the funds and now it doesn't get forgiven. So now I am really out that money. And so I really want to caution people on taking those strategies and doing those things until we have a little more clarification. If we get to the very end of your 8-week period and you need to do something or you want to do something, I mean, that's a potential option, but know your risk when you do that. There's a question here, can we retroactively pay employees for lost wages prior to the COVID? If so, would we have to repay unemployment claims? Again, it's a situation where you could pay the employee some additional wages or compensation, but if they're an hourly employee, I wouldn't probably recommend that. If they're salary and you want to, restore them a little bit, maybe that's a possibility. But I wouldn't go too crazy on trying to burn up the proceeds at this time. Try and know what your exposure is, know what you're potentially leaving behind, and then let's strategize around what we can do to potentially use that up as we get more guidance. All right, so hopefully that answers that question. So number 7, okay, so I'm going to disclaim this on the front side. This is a very tough question. And quite honestly, I'm probably not going to have a lot of clarity, but I want to share a little bit of thoughts with respect to it. Basically, is addressing whether, a situation where an employer has temporary help. And as part of the PPP application process, we were able to include temporary workers and those types of things. As a result of that, we believe that the intent of the law is to include temporary employees, and that you potentially could include them. So at this point, I would include them in your calculation, recognizing you need to get the documentation from your the temp agency. Obviously, if you have PEOs, which are professional employment organizations, if you have those, you want to get the information back from the respective agencies so that you can submit that with your forgiveness program. Obviously, if you're including them asking for the payroll costs, we have to include them from a full-time equivalent analysis as well. So if you're including your temp employees from a full-time equivalent perspective, from a payroll cost, you want to include for a full-time full-time equivalent analysis as well. So at this point, believe that the application should include them. It's not specific and does not give us the direction to say conclusively. So kind of know that that's a little bit loose yet. With respect to annual Christmas bonuses, again, there's nothing in the application that says we can't pay somebody more during that 8-week period. Obviously, if you push somebody over the $100,000 a year, that's going to be limited. Again, if you're not going to pay if there's a chance you're not going to pay that Christmas bonus at the end, you want to be careful not to pay it now, because if there's additional guidance comes out and says, oh, the max you could do is 2019's compensation, well, then you're going to be, potentially at risk. The other thing is we are considering prepaying a full 2 weeks payroll during the 8-week forgiveness period. The payroll has to be paid and incurred. I would say that if you're prepaying somebody, that's not meeting the incurred. And as a result of that, I would say not something I'd be overly comfortable with, and we can go from there.
Dan, I do want to go back to your first question and just let everyone know that the SBA puts out a frequently asked questions. And one of the questions in there is specific to, it says a PEO or similar providers. It doesn't say temporary wages, but someone has asked, what if an eligible borrower contracts with a third-party payer such as a PEO? And the SBA's answer is yes, they can include those. However, they will need to get documentation from the PEO of payroll reports to provide with the application, the forgiveness application. If they are unable to get payroll reports, it says that they will need a document from the PEO or third-party payroll provider telling them what this information is and that they are not taking the forgiveness or using that on their application. So again, as Dan said, it doesn't specifically say temporary workers. It really says PEOs, but we're thinking that possibly more guidance could come out to include that. So definitely if you have a PEO, those can definitely be included.
Okay, so I think we're ready for some more general Q&A. First of all, I understand I had some audio issues earlier. Am I okay now? All right. So I feel really bad because I had some really poignant and thought-provoking comments that you all missed, but alas, we'll have to just answer as many questions as we can. So we have had a couple questions come in, guys, about questions on transportation. Can you clarify what transportation costs are included? One person is asking, it's listed under utilities and loan forgiveness form. Is this payment for company vehicles, receipts for fuel for the company vehicles, something else? Nancy, why don't you go ahead and grab this one?
Yeah, so it's funny because we asked this for many, many weeks and no one seemed to know the answer to what this transportation was, but we have recently figured out that what they're referring to is there are other states that actually have a transportation utility fee. I would assume it's for large vehicles that they're using roads for. Not exactly sure, but I do know that in Wisconsin, we do not have a transportation utility, and therefore there's nothing to include in that utilities expense account. But other states do have a very specific transportation utility.
Nancy?
Yes?
Just read a Forbes article that said something to the effect of you can include your mileage expense as part of transportation. So there's another opinion out there from a Forbes writer that seems to expand that transportation to include mileage expense.
Yes, and I actually did read that, but I read that was specific to Schedule C filers. And so I also want to clarify, and again, we're reading a lot of different things and we're hearing a lot of different things, none of which are coming directly from the SBA. That's the problem. But I also read something where you can include car payments, interest on car payments, but that was specific to Schedule C filers. And remember, the forgiveness for a Schedule C filer is basically going to be 75% of their 2019 Schedule C. So of course, everything is included in there. So I'm not sure where they're differentiating between a Schedule C filer for that particular issue, Eric, and just a general, an S corporation or a partnership. But I have read different things from different sources. So I think until the SBA comes out with something a little bit more affirmative, we're going to have to wait on that.
Yeah, I agree. I think we're going to get actually more guidance on that one from the SBA. Mm-hmm. Because I think they've been responding to their frequently asked questions for questions that are frequently asked, and this is going to be one of them.
FAQs for FAQs. Okay, that's exciting. All right, so some more questions that are coming in about last week on our webinar. There was some talk, there have been some rumors that the forgiveness application deadline may be extended. Number one, has there been any talk about that? And then there have been some questions as well about what if your forgiveness application is due before June 30th? Nancy, why don't you go ahead?
Yeah, we have not heard that there has been any extension to the June 30th date at this point. We also would not encourage anyone to fill out their application prior to June 30th, nor do I think anyone needs to. Because remember, you have the application date says that the application is due 10/31. And then the bank has time, the bank has, I believe, 60 days to then look at that, approve that, and then the SBA has another 90 days before they're going to accept it. So because of the June 30th date, giving you the ability to restore your FTEs by then, if your 8 weeks ends on May 30th and you're not at your full time because you're not at 100% yet, I would absolutely not fill out that application yet, because you have another month to hope that you can open up and get all of your FTEs back to where they were pre-COVID and not have a reduction in your forgiveness. So the applications are not due on June 30th. There is no specific timeline on when you fill it out, other than the application form says 10/31. But you don't have a certain amount of weeks from the date of the loan. At least we haven't seen anything that says that.
Yeah, Nancy, I've seen some of the questions come through on here now that talk about a 6:30 deadline for the application. There is no 6:30 deadline for the application. Just want to be clear on that. The application itself, the best we can infer a deadline for it is 10/31, because that's what it says, that the application is good through 10/31. So October 31st is our best guess at when the application due date is. But certainly don't fill it out before June 30th because of a couple reasons. One is what Nancy said, you really need that June 30th date to potentially meet a safe harbor and increase your loan forgiveness. The second is there could be legislation that comes in between your 8-week period end, let's say it ends on May 30th, and there could be legislation that still comes in prior to June 30th that could increase the amount of your loan forgiveness because the laws will change. So the rush to complete a loan forgiveness application is probably not needed. What you want to do, I think, is take some prudent time here and watch how the rules develop prior to filing your application, which certainly means waiting until after June 30th to complete it.
Right, and I would agree with that. You know, the only way that I would say, hey, file your application would be is if you go through the analysis and you're getting 100% forgiveness with the current rules and the current guidance, you know, then you can put that thing behind you. The reality of is all the analysis that we're doing with respect to clients is nobody's using up the full nobody's able to forgive 100% of the loan at the current time. So we're seeing, you know, we're kind of riding along with this, trying to optimize it and try to get as much as we can out of that forgiveness period. But then, you know, we're also hoping that legislatively, right, they extend it to 12 weeks and that type of thing. If we file our application, yeah, there's maybe going to be a correction period that you're able to apply and get that, but there's really no need to rush and do those things. So I think from that perspective, I'm along with everybody else. We wait, you know, probably until the end. And the banks aren't going to like that because that's a lot of applications that they're going to have to review in a short period of time. But I think that makes good business sense at this point.
I also have seen a question in here, somebody asking if they can use their FTEs on 6/15 versus 6/30. I would say no. I think you have to follow the application. And if that's the date that the application is telling you that you can look at to determine your FTEs, then I think that's the date that you have to use. Because remember, you're going to have to provide payroll reports and some type of support that supports that. And if you had higher FTEs on June 15th and then you laid a bunch of people off on June 30th, I think that could be a potential problem. So you have to follow the dates in the application.
We've having a few questions about raises and bonuses during this time, one specifically about family members. Can you pay raises and bonuses to family members? Dan, you want to cover that one?
So at this point, we don't have any, we certainly expected that there be some kind of related party rules with respect to bonuses and paying employees. At this point, paying family members as employees, we're not seeing that necessarily in the application, but I think either there's going to be a regulation or something that's going to come out and define what an owner is. And the owner might then include related parties of, you know, children, spouses, that type of thing. So at this current time, we think that, you know, the application would allow that, but I would certainly caution people on thinking that that's going to be your solution to using up the forgiveness amounts, as I think there's going to be some clarification on that front. With respect to bonuses, as I said earlier, you know, you can pay an employee more, and I think if the employee is not a related party, I think in most cases you're probably going to be okay, but we can't say that with any certainty. The intent of the law was to basically put money in employees' hands for the stimulation of the economy, and also to keep people paying their bills and keep them employed. So I don't think there's a negative result of paying somebody a bonus from a government perspective.
Okay, we've had a couple questions coming in from an ownership perspective. Are owners' health insurance and retirement match contributions eligible for forgiveness? Nancy, go for it.
Eric, I thought for sure you were going to grab this one. We're hearing some very different information circulating out there, so I just want to clarify that again. So we believe that health insurance benefits, for example, for an owner of an S corporation, is going to be considered in the wage calculation, because those benefits are added to an S corp owner's W-2. So they are considered a wage for the S corp owner. So we believe those are going to be part of the wage calculation for the owner. For a Schedule C filer, however, we do not believe that that's going to be part of the calculation for forgiveness, because those are not deductible on the Schedule C, because again, they're basically using the 2019 Schedule C.
Okay, question about paying rent ahead of time. Can you pay a few months' rent ahead of the usual schedule and use it in the forgiveness application? Let's go with Dan.
So the prepaid of rent, we got to remember that there's documentation requirement that has to go with the forgiveness, and it's going to have to be governed by, you're going to have to send a lease, invoices, payment. In the event that the rent is outside of a prepayment, it's a prepayment, there's the big risk that the forgiveness portion of that would get kicked back because it wasn't for the period, that 8-week covered period. So I would be very reluctant to do that. There is some wiggle room in the application that does appear that you could pay something, a little bit earlier, but again, you got to be careful on what you're able to document and how you're able to position that. I think the lease and the rent's a tough one, but you might be able to get some utilities or health insurance or those types of things in the 8-week period by paying them a little bit earlier.
I'm also seeing people ask questions about paying rent in the arrears. Again, very similar to prepaid. I do not necessarily think that that's going to be allowed. I think that they're going to allow you 2 months of rent per a lease. Remember, you have to have a lease in place in order to take the rent. And I think they're going to look at the rent that's on the lease, and they are going to allow you 2 months of that rent per the lease agreement. So I don't think paying a back rent or prepaying is necessarily going to be allowed in the forgiveness calculation.
So Nancy, I think that's correct. That would be with the intent of the law. We believe the intent of the law. There are other write-ups out there, though, that talk about the SBA guidance that said you specifically can't prepay mortgage interest. But they didn't say you specifically can't prepay anything. They said you can't prepay mortgage interest. So the argument would be, why did they pull out mortgage interest as something you can't prepay and exclude the others? Does that mean you can prepay the others? Otherwise, the SBA would have said not. So I think that's still an open question out there. And the guidance does say, paid or incurred. And so there's a question on that. What does it mean, paid or incurred? Can I only take incurred expenses? And do I have to be consistent, or can I only take paid expenses? Do I have to be consistent? I don't think the answer is you have to be consistent. It says paid or incurred, which means that some expenses could be paid, some expenses could be incurred, because there's specific guidance that talks about incurred expenses that are paid in the next normal pay period, even if they fall outside of your 8-week covered period. So I think there's going to be some open interpretation there. The guidance might come out to be aligned with what you're talking about, which is we really intend this to be a 2-month expense coverage. But if it doesn't come out, these might be loopholes to squeeze more out of your loan forgiveness.
Yeah, and I think the practice of this is, we want to basically try to use up the amounts that we have available from the loan. But if we're going to go and prepay rent, that might be fine. But just know that when you do it, you might not get forgiveness on it. So you might want to also do some other things and pay some other things that you think might also include or be available. It's kind of hedging your bet. I mean, you really have the money to spend and pay those things. So it doesn't hurt you to pay, 2 months worth of rent or whatever that case may be, presuming that you didn't have that money could have been used for something else that you might be more eligible for a forgiveness. And as Eric said, it's incurred or paid. So, maybe I have the ability to pay, a lease payment or some particular charges. Maybe there's the ability to pay those as well. It's really a planning opportunity, but you don't want to pay something that you wouldn't normally pay. So I don't want to go and pay. I use the employees as the bigger piece, because if I want to just go give somebody a $5,000 bonus, but if I didn't have this loan, I wasn't going to pay that person $5,000. Maybe I shouldn't do that as my planning strategy. I want to be, things that might be eligible and might be in line to get that forgiveness.
And remember, for the rent and the utilities, you are up against that 25%. So if you're already at the 25%, it's not going to benefit you anyway. So if you're trying to get 100% of the loan forgiven based on the loan amount, but you don't have that 75-25 ratio in payroll and other expenses, prepaying anything isn't going to help you in that situation, because you will be up against the 25%, at least the way the law stands right now. Again, they may come back and change that. We don't know. But as of right now, that ratio still exists.
Okay, we've only got a couple of minutes left, but there was an interesting question that came in about whether or not you guys have seen payroll service providers creating FTE reports to help their clients perform this calculation. Have you guys seen any of that?
I have not seen it yet, but I know that when the application process for the actual loan was coming out, I did see some of the payroll providers coming up with reports that gave them that information to put on the application. So I wouldn't be surprised if they will come out with that information.
Okay, thank you. I'm realizing as we're doing this, part of our thought of doing a 1-hour Q&A was to finally get a chance to really answer everybody's questions. And yet here we are again. We've had, I don't know, maybe 100 or so questions come in. We've only gotten to a small percentage of them. So if you did not get your question answered, I apologize. It can be really hard for us to know who the questions came from because oftentimes the name you log in under is not the name that you necessarily registered under. So I guess what I'm trying to say is all of these questions are very specific and we're doing our best to answer them. But when the rubber meets the road, it's really about how does this apply to your business? So if you're an SVA client, please reach out to your SVA professional. We want to help. Again, please don't reach out to our speakers unless they're the people that you typically work with, just from a standpoint of making sure that we don't have too many questions coming in to too few people. If you're not an SVA client, reach out to me. I will get you some answers. I'm happy to help. We're only a phone call or an email away. We've created a resource page where the recording of this webinar will also be available if you want to re-listen. Bookmark svaccountants.com/COVID-19 as a resource for you and your business. We will offer additional webinars when needed. We're going to kind of come up with them as we go, just like we did with this one. But please stay tuned because we're going to continue to stay as on top of this as we can. You know, I guess the other thing I want to say, and I've mentioned this sort of before, but Nancy, Eric, and Dan, thank you guys. You guys and really all of our staff have been working so tirelessly to read the legislation, to interpret the contents, and then package it and communicate it out to the entire business community. There has been a lot of conflicting information out there, and these rules may apply to each business a little bit differently, but I'm really, really proud of the way that SVA has been such a leader in helping so many companies through this. You guys have really been awesome, so thanks. Having said that, we are going to wrap up. Thank you again for joining us today. Hang in there and be well.